Hello, everybody. Welcome to our Tuesday edition of the TraderMerlin Show. I am Merlin Rothfeld. Hope you guys had a great day out there. And hello, everybody. We've got a nice talkative group already. We've got Jorge. I see Naum, Jerry, Dana. Good to have you with us. Big Eb, Raj. Got Les from Cape Canaveral. I hope that launch was awesome for you, and I hope everybody saw the amazing celestial event last night with Saturn and Jupiter forming the North Star. Of course, as always happens, I go in the media and the news, and they say, this is the once-in-a-lifetime event. You'll only see this one time in your lifetime. And, of course, right as it happens, a big cloud bank shows up right in front of me, and I can't see a damn thing. That's just the nature of the beast. It's like the trade that got away. So I tried to see it last night, but the moon looked great, but Saturn, Jupiter, forget it was over. Anyway, hope you guys are doing great. We are going to go to a topic that we covered back in August. Now, we are obviously at near the tail end of December, so we're looking at several months ago. Let's see, August, September, October, November. So about 4 months ago, we had Jeff Manson on the program to talk about this topic, which was the market melt-up. And back then, you might remember, I actually posted a little clip from August 6th. Jeff says, in the next 18 to 24 months, I could foreseeably see the market doubling. And it has been on an absolute roller coaster. It's been on a more of an upward trajectory. So I almost wanted to put part 2 next to this called the market melt-up. And of course, with us today is none other than Mr. Jeff Manson himself. Jeff, how you doing?
Hey, I'm doing great. Thanks, Merlin, for having me.
Always a pleasure having you on, my friend. What's new in your world? I know you and I did some stuff the other day for, what was that for? The Signature Series Showcase, which we'll talk about. But how's your trading world going?
Well, trading world's doing great. Had actually pretty blockbuster day yesterday with a couple of little trades, just in the GPS session and also in personal account. I was ready to do the happy dance yesterday. And today,
we love the happy dance.
Yeah, today was good. We had a trade that I posted out there on Twitter, which was the natural gas trade, and I think a few folks have participated in that. It was pretty nice. It was a really good, nice move. It started last night and it just kept on going right up.
It's not just particular to natural gas. I mean, we've seen some huge moves, especially in that commodity space in the last couple days. I'll bring up the chart for the viewers out at home. Here is the natural gas chart, NG. See a nice big green candle today, moving upwards to the tune of about 2.44%. But we've seen a lot of stuff here with copper. We've seen some pretty big swings. Is this kind of becoming your focus right now? Is the commodity side of things, given how weak this dollar's been, Jeff?
Yeah, the commodities, though, it's more on kind of unnerving as far as the focus on commodities, because I keep seeing these little news wires that keep come up, but they disappear real quickly, and they keep talking about the different food shortages around, not just around the country, but around the world. And it's not alarming because they're not putting a lot of that out there, but I do see a lot of focus and some growth potentially coming up with the food shortages, especially in the agriculture and livestock and hogs and so on.
Obviously I had a little bit of fun with the intro starting graphic for today's show. I don't know if you guys can see there clearly, but I had to throw little Jeff's face on that picture there as they're going to the Mars, going to the moon, going to the Mars, wherever. Medic Man down says S&P going to Mars. We could dive into some of the individual pieces, but let's take a look at your continued thoughts, because obviously we've got a Fed who is just going to help push things in one direction. The government who, by the way, the government just pulled an amazing scam on the American people, by the way, with the stimulus. And I'll give you guys a clue as to why this is one of the biggest scams you'll ever see in your lifetime. You guys were all friggin' ripped off yesterday.
Yep.
Just so we had a $908 billion stimulus package, right? Stimulus package for the U.S. to stimulate it. Just want you to do something real quick when you guys have a chance during today's show. Take a calculator, and I want you to multiply a $600 check by every living person in the United States. Now, let's be clear. Not every living person in the United States is going to get a check. You make over $75K, you don't get one. You're under a certain age, you don't get one. But let's just assume that every single American got one of these checks. As of 2019, there was 328 million Americans. You could round up if you like. Take 328 million, times that by 600, and see if you get anywhere close to $900 billion. And like that money disappeared. Anyway, we've got this super accommodative Fed. What do you foresee happening going forward? Are you still as optimistic for the melt-up going forward?
Yeah, I mean, every bit of money that they put in and put out there goes right back into the market in some form or fashion, unless you just go bury it in your backyard. But even that, you'll have to go buy a shovel. But the thing is, they're pushing this market up, propping it up. We have new technology, which is probably going to be some of the main focus. I'm seeing a lot of these things just like we saw in Y2K with brand new technology, brand new things coming out. There's also that fear and driving things a little bit crazy. But this melt-up phase, I didn't see it the first round. I was still pretty young in the market, and at that time, I was trading options, and you just throw a rock at the market, you could make money. But we haven't started that strong melt-up phase because of all the different shenanigans been going on with election, with the COVID and such. But right now, as it stands, since mid-March or so, they put over almost $3.2 trillion into the market.
Yep. More.
And
I mean, collectively between the Fed and our governments, it's more than that. I mean, it's considerably more, which is crazy.
it is crazy, and for this market not to start flying to the upside, it's just crazy. I mean, once we get back out and everybody gets vaccinated, everybody starts going out and buying things, and this thing is going to heat up. And you've got to be prepared to take little strategies. One of the strategies that I've started to employ a lot of this in a very small stock account is the debit spread.
Yep.
And that little vertical debit spread, I'm still going out, they're about 40 to 60 days out. And I've noticed that my little trading account has, I got a 30% bump just in 1 week.
Wow.
It's just picking a couple of little trades there. So they were conservative. But with this market going in one direction, and it really hasn't had many corrections except for some small ones, one big one. During the last melt-up phase, though, there were 5 corrections between about 9 and 13%. So on my charts, I'm always marking, every time we make a new high, I'm kind of plotting out where's the 9 to 13% pullback. And that way, if for some reason we wake up and things are dropped because like what we saw this Sunday, you can look to be a buyer. At least you know where you're going to buy.
Right.
And I think everybody should have that list of stocks, that list of things that they're going to get into for a period of time. It's still, to me, more of a trader's market at this point. But some of the longer term holdings I've had have done pretty good. How about that Bitcoin, huh?
Yeah, well, I'm always a fan of crypto, so yeah, I'm happy with that. With regards to the market trend, obviously, if anybody's just buying and holding right now, you're doing great in the face of all this crazy adversity. Where when I say adversity, I'm talking about all the economic issues, people being displaced from their jobs, etc. But we do have, again, the stimulus coming in, and for those that read through, I'll probably talk more about this on tomorrow's show on some of the ridiculous things. You know that there was one in the small print of the stimulus package, right? Mind you, this is stimulus for the United States of America to help us get back on our feet. One of the little line items there is that racehorses must be tested for steroids. Like, I want to know what freak will the senator from Kentucky please take the floor? He's like, I want to make sure my racehorses are tested for steroids. It's like, yeah, sure, that'll give somebody a job. Why not? I don't know. There's so much bizarre stuff that happened there. But one of the things that I find interesting about your analysis, and if you guys, we'll talk maybe a little bit about his signature series coming up here in a minute, is you have an ability to look for these patterns that repeat. Now, when I say patterns, most people are thinking haramis, ascending triangles, descending triangles, a chart formation. You dive a little bit deeper. Maybe you could share with our viewers kind of how much time you spend looking for these patterns. Like every time it breaks a new high, we see what I think you said 9 to 13% correction on it. I mean, those are noticeable things that you should be paying attention to. How much time do you spend scouring the market for those relationships?
Well, they pop up in the media quite often. Okay, and so it's not like I'm out there dissecting everything. When it pops up, I go and verify information. Did it happen? Okay, how many times did it happen? What did it look like? Then I kind of dig into it. These are not, a lot of the numbers and statistics that I quote are from other sources out there. They're not necessarily something that I've conjured up all alone. But verifying that information makes you a stronger trader. And as you verify and document that information, you start to incorporate it into your trading plan, and you start finding additional ways to capitalize on it, especially for like option traders and some of the bigger structures. Taken and many people that have been with me in the extended learning tracks that we do for Online Trading Academy, you've started to see a change in the picture. We're looking left a little bit further than just looking right at that hard right edge and trying to make a decision. And so the structures are different than an area and different than a formation and different than a zone. But we kind of use all of them together. And it's so amazing how fast our subconscious, once they know the pattern, that your subconscious just nails it right away. It pulls it right out of the chart. You still need to develop the confidence and discipline and the focus of repeating it the same way. One of the things that I've done on the signature series is nail that zone where I'm looking to place a proximal and distal line to a very small group of candles. And the candles have to be in the right sequence. They have to have the right colors. They have to be in the right area, within the right structure. And it's that programming that some of you see very quickly and some see naturally. It takes me a lot longer to see it. So I have to construct it. I have to measure it. I have to document it hundreds of times. And the more that I do that, the faster I get, the more confident in my trades. I don't think there's been a period at all in my trading history where I've been this confident. But I'm still learning. Don't discount that. I'm still learning different pieces of the puzzle because certain market conditions and, of course, the fractal nature of things. This is the same pattern on a 30-minute chart as it is on a weekly chart. It's just my temperament for taking trades is more small term, because I like to see it work, and that's why I do spend a lot more time in the shorter time frames, because I'm constantly proving these things to myself and to anybody that wants to listen.
Yeah. Hey, no, I like it. I'm a fan of it because I'm a pattern person primarily, and when I say patterns, I'm looking at the traditional sense of. I love shooting stars, I love candlestick formations, and like you, I have a very specific set of rules. And I will tell you guys, if you go through and I might even have it here, this book here, which is wildly overpriced. Do not go buy this one. You can find it. This is the Japanese candlestick charting techniques from Steve Nissen. He walks through here ways that you should trade these and what they mean, all the psychology. You guys, you don't need this book. You listen to the show, I'll tell you everything you know about candles, or go to Jeff and he'll teach you as well. But what's interesting is about Steve Nissen is, from what I understanding, the guy doesn't trade. That's what I heard years ago, and I'm like, okay, well then, that's like a virgin giving me sex advice, right? It's just not going to happen. With candlesticks, Steve Nissen says, here's how you're supposed to trade those. I don't listen to that whatsoever. I find what works for me, and I've shown you guys kind of the patterns I'll do for shooting stars and hammer formations and haramis. There's rules that I put in place. There is no industry standard rule for these things. What's interesting about all trading is we have to find what fits us. And, Jeff does a great job of explaining that. He just kind of mentioned it there in passing, though, is he's adapted those. It's got to have the right colors, the right setup, the right structure, and then once you find it, you have to trade it a specific way. And I think that that's important for all of us to understand, because we're all going to do things differently. Even if we're taught the exact same way, we have to find out what works best for us.
And really, you take the information from all of our instructors, you take the information from what Merlin shares with you, anybody, and you verify it. And the more that you verify it, that's the only time that really you start to incorporate it into your trading plan. And your trading plan is something that really never stops evolving, because you might hear, hey, we got a new candle formation. It's that flying hibachi. Okay. And you're going to say, okay, well, what's a flying hibachi look like? Can you see it? And once you start nailing down what the exact picture is of that person's perception, you may like it or you may not like it. Many people turn their nose up at it if they have to do any extra work or it's foreign to them.
Mm-hmm.
As a instructor, as a educator, I've learned over the years that, set that ego aside and listen intently to everybody's version or way that they see things, because they can always help you see it a little differently. Even if you don't agree with it, you kind of, I know you do this a lot. You appease me when I start going off on a tangent. And it doesn't have to be part of your trading plan, and you don't have to trade it that way.
Right.
But it's always interesting to see what many people think, and we use that in our teaching as well. Is we see what the novice traders are thinking. We use trend lines, support and resistance, indicators, oscillators, but then when we start talking about supply and demand, so many people look at us like we got a third head.
Right. Yeah.
And they just don't. There's so many people that don't grasp the concept of supply and demand. And as of late, I've been doing kind of mapping out the way that supply and demand develops using, basically old resistance or old support, which is really where supply or demand was used up and then price broke through that area. Okay. That has to happen before you have a demand zone or a supply zone.
Yep. Absolutely.
So we've incorporated that into a trading plan. We've already been using that in the core material that, I get hired to do subcontracting for with Online Trading Academy. And we talk about the breakout segment. Well, in order to have that breakout segment, you've got to have some resistance someplace.
It's got to break through something,
Exactly. I mean, duh. But it's putting that into play and then putting yourself out there to say, hey, this should happen. Okay. I kind of did a foot in the mouth type trade today where I was looking at some of the internals that I use, and $TRIN is one of those, the short-term traders index.
Yep, I'll bring it up for the viewers out at home. So there you go. Okay.
Yeah, and it was trading above 1.5 for most of the day. And the last time it did that, traded above 1.5 for that length, we saw in the last 5 or 10 minutes of the session, the market just rocketed to the upside. Okay, so if it closes above 2, we can expect a gap up or the next morning. If it closes below 60, we often look for a gap down the next morning. And the old saying, trend is low, time to go, trend is high, time to buy. This has been one of my favorite pieces of information to look for when the market has been dropping. Because if you're not getting a high reading on this, when the market's dropping, they're not trying to slow the market down. Stop trying to pick the bottom. But today they were trying to slow it down, and we got a bounce at the end of the day, but not what I was expecting. So maybe in the overnight session it'll come back for us.
I want to kind of continue on with this train of thought here, because when you look at what a doctor does, you might go to the doctor and you're feeling fine, but then he does your blood test and he's like, oh, your lipids are here and your cholesterol levels here. To me, this trend, which I don't personally use, it's not one that I've used. I mean, I have used it over the years, but it's just one of the variables I don't look at. For you, though, this is that blood test. This is one of those things where he's analyzing a factor, a result of data from the market. And of course, we can go into what tick and trend and ADX and all these different things are. But it's a reading, almost like taking that, what do you call it, stethoscope, where they measure your heartbeat. I think that's what it is. This, to me, is very similar to that. And for Jeff, it's interesting because he's formulating a strategy based off one piece of internal information, and there's many other ones he's looking at, but this is what is unique. And there's a great comment here from Richard. He says, a trading plan is a personal roadmap to what you understand and believe that the current and future outcomes will be or not. I've tried to use this analogy in the past, and I always refrain from it because I know many people take offense to any religious references. But I'm not a religious person, so don't apologize here. But look at it as like a Bible, right? The Bible, from my perspective, teaches people the way to live their lives, the right way. Live, with courtesy and treat your neighbors this way, and thou shalt not steal, and these kind of commandments, if you will. To me, your trading plan is your financial Bible for whatever your trading plan is, and it's all the things that you should be doing. It's all the rules you should be following, and if you don't follow that, well, you're going to go to financial hell. Sorry, I had to twist that one in there, but sorry for the bad analogy, guys. If that was offensive, I apologize. But, I look at my trading plan, and I believe, Jeff, you probably do as well, where this is your roadmap to get to the destination that you want to get to. If you're in the Bible, you want to get to heaven. If you're trading plan, you want to get to financial Mecca, if you will.
Yeah, it's just one piece of information, but it's been very reliable, just like a specific pattern you see or pattern recognition. Like the ones that have a strong move up, like a bull flag or a bear flag, all those are patterns that help us make decisions. And most traders don't realize that the shapes, the angles, the slopes, the patterns on the charts are what cause them to buy or sell. Okay, and it's that emotion, and the emotion is based off of patterns. That's called your subconscious.
Right.
Okay. And again, the subconscious basically takes patterns and shapes and it creates feelings. And it's very consistent that way. So when somebody says, hey, I saw you looking at a 34-minute chart, what's so special about that? Well, I turned it down until the pattern came into focus. You might be able to see it on a 30-minute chart, but with my eyes and my glasses, I might have to turn it to a 34-minute chart to see the same thing. Mm-hmm. But it's that very specific nature of your trading plan that allows you to make those decisions and verify if your trading plan's any good. You have a place to document. You're not all over the place. Right. And that's key importance, is not to be all over the place, but focus on what exactly am I looking at? And then if you can replicate it, and what I try to do with some students here is I said, all right, show me your picture perfect setup. And they look at me like, what? What's my perfect setup? I said, do you have a shape or a pattern you look for in market? Well, I don't know. Well, what caused you to buy ABC company today? What caused you to short this one or go long this one? Well, they can't give me an answer. Yeah. And that's really disturbing to me, because you might as well go to the casino or just continue to buy lotto tickets. You'll have better luck. At least it'll last longer. Okay? If you cannot replicate your price pattern or your picture on a price chart, if you can't teach it to somebody, then you just got a concept.
Right.
You don't have a trading plan. And I got schooled on that pretty hard when I was back in the day trading shop, when the old sweatshops down here in Arizona. I had good old Mark Selesnov. He was the broker down there. Kept telling everybody, bring in your trade plans. I'll go over them. We'll verify them and stuff like that. And I said, well, I have no idea what a trade plan is. Give me one. I said, nope, that's got to be up to you. I was like, all right. Went home, started looking around, trying to read about what is a trade plan. And first, I come back in the next morning, just revved up. And we got like 35 people crammed into this small room, double those big CRT monitors. And
you're dating yourself there, buddy. I remember those.
Yeah, I remember seeing pictures of you. But he looked at my trade plan all of about 3 seconds, crumbled it up, and threw it back in my chest in front of all these other traders. Said, you don't have a plan, you have a concept. Well, it took me about 5 times of doing that, and finally the 5th time it was a stochastic moving average, MACD crossover, buy here. I mean, it was so detailed that everything had to line up. When it did, you hit the buy button, and I couldn't give him any information, and finally when he sat down, he looked at it. It took him more than 5. He was onto something, because with 10 seconds into it, he grabbed a piece of paper, walked over to another trade desk, sat down, found the setup, made a trade, made some money, He said, handed a piece of paper back to me. He said, now you got a plan. Go back to work.
Right.
Has to be specific.
Sure.
And detail.
And the challenge is we have to find out what specifically works for us. And I've mentioned this many times because so many people are looking at different things. You've gone through all the different indicators and analysis tools out there, so we won't go into those pieces. I have a couple questions here, though. Let me go to one. Adam says, I know Jeff is a fib guy, but are any fib numbers that you consider to be breakout fibs? I've heard... Oh, just went off the screen. I've heard this from other traders about specific fib numbers if your fib is drawn correctly. And, of course, that right there is the tough part, is drawing them correctly, because a lot of people draw them from different locations. Starting points, end points are critical. Any little deviation there, those numbers all change. So are there any that you view as kind of breakout numbers?
Well, if we're talking about a breakout number, we're looking for a Fibonacci extension, okay, based on, and pretty much when you're measuring Fibonacci extensions or retracement, you need either, you have to have a standard way that you're going to do it, either at peak to peak or valley to valley, peak to valley or valley to peak, okay, or for what I've been using over the last few years is a quality demand zone or a supply zone, and starting with the distal line. Start and hook my little measuring tape on the distal and go to the rally, and so on. That is the only way that I've really gotten myself nailed down to trading the Fibonacci measurements, is by having a qualified supply zone or a demand zone based on my personal trade plan. Which are the candle formations that I made reference to. And in the Signature Series class, I started showing everybody what those candle patterns are. We spend a lot of time verifying that information so that we can start to use it, start to believe it, start to trust it. And, that's a big thing. You got to trust your trading plan. And so drawing the Fibonacci extensions, I use some basic extensions, a 113, 127, 161.8, 224, 261.8, and a 314. Those are my Fibonacci extension lines. Where I derived a lot of those from are different patterns that tend to repeat a lot. A friend of mine, Scott Carney, I don't know if you've interviewed Scott.
No, I haven't. Get him on here. Let's do it.
Yeah, I'll send him an email. But Scott Carney at Harmonic Trader many years ago published his books, Harmonic Trader, and I'm just like, there's no way the market could be that specific, because I was so conditioned everything was random. And he kept using the same Fibonacci extensions and retracements over and over again to create these little pictures. Well, this happened in the early 1930s. We had Ralph Nelson Elliott that was showing different patterns. We had Barton Pugh. We had Gartley. H.M. Gartley. He started showing some additional detail to some of these patterns. And what Scott did is he started mapping them out with Fibonacci retracements and extensions and creating these little patterns. Now he has a bat pattern, a crab pattern, the Gartley pattern, and so on. But that symmetry that we see in the market is very much alive and well. And we can use that to match up with where we would see a demand or supply, okay? Right. The Fibonacci measurements, and I really just refer to the Fibonacci extensions and retracements as a measuring tape. And that geometry does fit into my trading plan, because I see the shapes and patterns before I see the area, before I see a formation, and before I see a zone. It's like, okay, you got to start the big picture and you got to zoom in. So how do you do that? Because you just can't keep calling everything the same thing and think you're going to get like a zone is a level, it's an area. I mean, no, you got to separate the words out a little bit and have a specific picture for each one. Right. The extensions and retracements, my resource, and I don't like to, I'm not going to pleasurize. If I know the person that says it, I'm going to make a reference to it. And Scott Carney was very, very instrumental in how I use Fibonacci measurements, and opened my eyes to something that I didn't know it really existed.
Yeah, and with regards to those fibs, I use extensions as well, but generally I'm sticking to the main, the main ones, and of course, the main stuff you're looking at is going to be your 618, your 38.2. Jeff goes kind of smaller on those as well. He breaks those down a little bit further than I do, and that's just a matter of personal preference. The nature of fibs, of the fractal, of the whole golden rule, if you will. It's pretty fascinating stuff. Maybe we can do a show one day just exclusively on fibs and the magic that they entail. A couple questions here. Mike asked you about different securities like hot stocks, and I know that as a trader, you're basically wherever the opportunity is. He says, does Jeff follow any of the hot sectors like marijuana, solar, Bitcoin? Many of these are no longer penny stocks; they're legit, high-priced items now. Do you trade and follow those?
Right now, over the last since about the beginning of this year, 2020. I've solely just started following just the Fortune 1000 stocks, and that has been my universe. I mean, there's 1,000 stocks in there. Some of them are very cheap, like SWN was one that I recommended out there, and there's some that are very expensive on the Fortune 1000. When I'm trading supply and demand, it is important that the banks and institutions are there. So you have some stocks, and one of the a young kid, his name is Errol Coleman, has been showing me some of the things he's been doing on small cap stocks that have like a huge run up during the day, and he starts to short those. But for me personally, trading supply and demand, I am more focused on stocks where the banks and institutions are more actively engaged. If I'm looking at something that's not a high flyer, I wait till it is up in that range or has graduated up into that before I start actively trading it. And that's just a personal preference. That's not saying that some of those stocks don't work. I mean, I've have one stock that I'm actually going through this. I don't know if you've ever done this. I got restricted shares, and just as of recently, I had to send those certificates in to get the restrictions taken off because the company's about ready to go public. Now, I don't do a lot of those, but this company, if everything opens up the way it should be, I'm going to go on sabbatical for a couple of days. I mean, it's a pretty healthy paycheck. But it's interesting kind of going through that process too, because it's like you got to make sure everything is lined out.
Yeah, I don't get restricted shares. Well,
every once in a while, you'll get a good tip from a buddy or something like this, and it was a very small investment for me, but it's turning out to be a pretty large payout.
Yeah.
So
congrats.
Yeah.
You mentioned Trin. Okanola wants to know if you use the ADD, which is Advancers Decliners, as well, and I'm pretty sure that you do.
Mm-hmm. All right. Yeah, the $ ADD, which is the advancing issues over declining issues for the New York Stock Exchange. Okay. Now, I have some upper ranges, which would be about 1,800 to 2,000 on the positive side. And then I have a lower range, which is negative 1,800 to negative 2,000. And I have that middle range, which is negative 500 to positive 500. And I kind of color that area gray. The reason I do that is that you can see that most of today's action was in positive to negative 500. And that just means that there were pretty much equal number of advancing over declining, and it was an inside day. So it's really a slap in the face saying, hey, you're going to lose money if you keep trading during this day, okay? Or you're going to overtrade. I mean, you can get small moves, but if you hold on for 1 minute longer, you'll give it all back real quick. And I'm sure there's a lot of people that kind of felt that today. And now, I use that again as more of something on my dashboard, whether we have enough gas to get from point A to point B, or whether the oil pressure or temperature lights or engine lights coming on. And when that advancing issues over declining issues are pretty much equal, or between negative and positive 500, it alerts me that if I choose to trade today, I'm choosing to take extra risk. Okay. When I'm doing an online class, I try to temper down the number of trades that I take during that time, because I'm pretty much going to get stopped out if I try to hold on to it. So the advancing issues over declining issues for the New York Stock Exchange is another one of those internal pieces of information that I look at. It no different than calling it a dashboard. I mean, you just don't stare at the temperature light while you're driving to make sure it doesn't go up or down. You make a quick reference to it. And if it's getting hot, well, then you are too cold, you know something's not right. Something's not running right. Okay.
On the chart here, let me real quick ask you. So I'm trying to map out for the viewers at home so you can kind of see how this looks. I know the chart. You're like, what the hell is this chart? Just get rid of it, right? It's basically just measuring the companies that are moving up versus down on the New York Stock Exchange. Now, I think you said, and I'm colorblind, but basically between 500 and negative 500, which I think that's like a light green on my screen. I apologize, people. I am colorblind, so I admit it. That's kind of really not that critical of an area, right? That means that things are just kind of traversing sideways. No big runners, no big move up or down. Now, if you get between 500 and 1800, that means we've got a nice strong trend going, and that maybe we can color that one green. If you start to get above 2000, though, is that kind of a sign that things are overheated?
Yeah, between about 1800 and 2000, that's when you start getting to the extreme. So if it's on the positive side, you would start hunting or being prepared that markets are moving up, start looking for supply zones. That doesn't mean it's going to stop once you see it, but that supply zone in the context of a downtrend it's basically you're seeing a rally up off of a downtrend. It's going back up into supply. Okay. Conversely, if you're looking at negative 1800 and negative 2000, you start looking for demand zones because the markets are usually descending at time. You have more declining stocks over advancing. So the extreme areas are where supply and demand lives. Okay. So if all the New York Stock Exchange or a majority of the stocks on the New York Stock Exchange are negative on the session, then yeah, we should be looking for demand zones if we're looking for any trade at all. Or if they're up at 1800 to positive 2000, then we should be looking for prices moving up into supply zones. Okay. And again, it's the New York Stock Exchange. It's not an index.
Right.
It's the whole composite. So it's a broad range of things. But when everything gets overbought or everything gets oversold, it's a good indication to start preparing to see change.
Yeah, I'm trying to draw a couple other things here, unfortunately. So I got it mapped out for everybody, and I like the way that this is set up here because I think it paints kind of a quick little picture for you of it. Think of it almost like stochastics, right? Stochastics are, when stochastics is overbought, that doesn't mean that it's not going to move up anymore. It just means it's gotten a little bit overheated. And so what I color-coded here is, one of the uses for the advanced versus decliners is if you have more stocks that are advancing versus declining, that's a good thing. That means markets are trending, everything looks great. If it starts to tip too much, right, you're talking like over, he said 1800 to 2000. I painted that in red there because now you're looking at, am I coming into some potential supply zones because things have accelerated maybe a bit too much. On the flip side, you can see the green at the bottom. Green might mean that the market we got decliners leading, way outnumbering the advancers. Therefore, there might be some buying opportunities at demand zones if you find them. So these are just little internal things that Jeff talks about that to me are critical and I think are important if you're looking for that little extra quote unquote odds enhancers or something to help keep you on the rails. The challenge that you're going to face, and I would encourage you all not to fall into this one, is if you start using tick, trend, ADD, stochastics, Bollinger Bands, MACD, and all these different moving averages, pretty soon you're paralyzed and you will not make a trade. It's called paralysis analysis, where you just don't make any trade because it can't meet all those criteria. There's just too many moving parts, which is why I like starting with price exclusively, and then maybe you can add on these extra pieces that you find beneficial, but start with price.
And also keep in mind, none of these tick, trend, VIX, advancing issues over declining issues, none of them make my trade.
Right.
They just kind of tell me what's the environment. Are we kind of quiet today? Or are we at extremes? And at a quick glance, especially with the $ TRIN, if the markets have been selling off most of the day and we're going into the close where the market's going to close at the low of the day, I want to reference the trend. And the trend's going to show me that there was more upticks and up volume, even though price was going lower on the equity indexes. But there was, it implies to me that there was some buying going on, a lot more buying on the whole New York Stock Exchange.
Mm-hmm.
Okay. Now, I don't have the money to do that. But somebody, big banks and institutions, if they want to stop a downtrend, they buy into it. Okay. Even as we stop our car, we pump the brakes, and then we come to a complete stop. It's not lock them up at every stop sign. You know, it's we don't have that kind of reversals. So when the market's big indexes are slowing down, you may see some additional buying, more upticks and up volume than downticks and down volume. And for this reading, it is something that I reference. I don't do it every day. But when we're at market extremes, moving up or moving down, this is a great reference.
Mm-hmm. So I'd use tick as well. Raj says, Jeff, can you give your ranges for the tick?
The tick, $TICK, which is a New York Stock Exchange tick. Basically, it's a upticks over down ticks on a New York Stock Exchange. The upper range is between 800 and 1,000. And you treat the tick like a tachometer, and that's where you would put the red line up there.
Yep.
So as you're going up a hill, and that's a buy program when you're up at 800 to 1,000. If you go negative 800, that's kind of the tachometer going the other way, okay, and that would be a buy program. Actually, that's negative 800 is a sell program, and positive 800 to 1,000 is a buy program. The trap that people fall into with these is they look for this to give them a trade.
Right.
It's just a place where we may see a shift. The trade that you would be looking at to employ with this would be more of an exit strategy than an entry strategy. Okay, using the tech like a tachometer you would on your car. When the car is idling and just kind of cruising down the road, I have a range of negative 400 to positive 400. And that's when I just, you kind of get a feel that we're not at extreme areas where there's extreme buying or extreme selling. And with these go ahead, sorry.
No, it's, when I look at this, I'm not a fan of tick. For those that know what tick just means you had an increase in the current, in the most recent transaction, price ticked up. So when you look at your time in sales, if it went from $12 to $12.01 on the time in sales and the transactions, that's an uptick. If it went from $12.01 to $12, that's a downtick. I don't know. I used to be a tape reader. I mean, that's really what I did back in the late 90s. I don't really use the tick. I find a trend and ADD to be much more beneficial. This is really kind of looking at things under the microscope. And when you have something really running strong, you're going to have a lot more upticks. It helps a little bit there. But again, I don't want you guys to overcomplicate your trading, right? The goal is to keep things simple, the old KISS method. Keep it simple, stupid. So, you start to add on more and more of these things. It's nice to know what they are, but I think in the long run, they'll end up hurting you because you'll be distracted by so many of them. So pick a couple things that you think are good odds enhancers and stick with them. Jeff, let's talk about your signature showcase. I had the privilege of working with Jeff last week and a bunch of the other instructors from Online Trading Academy who are doing signature series. And you are doing one, I think it starts in March, called Training Your Eyes, right?
Yeah, and one of the things I've noticed in working with many students all over the world is that, people look at things weird. Somebody says, yeah, this is, a bull flag, and I'm looking at that, and I pull up the textbook, and I put the textbook right there, and I go, is that what that looks like? And they go, yeah. And I'm going, do we turn the computer, one turn or two turns? I just can't see the same things that they're seeing sometimes, and they're making trading decisions on it. Training your eyes is really an application class where we do several exercises, and I do have some additional teaching techniques that I use in as far as NLP and some of that programming, seeing the same thing over and over again, being redundant. And I get a lot of that from Zig Ziglar. He says it over and over and over again. Okay, but that type of programming some individuals need, and not everybody. But for myself, I needed to see it hundreds of times. I wanted to be able to do what the instructor was doing. I wanted to be able to call out the zones that were on the mastermind grid, or that another instructor was lining up. When I first started using this, I just tried to look at their candles. I looked at different things, and I would call that a zone. And sometimes I would call it an hour zone versus a weekly zone. And there was no rhyme or reason behind it. So training your eyes is a way of refining your trading plan. A lot of things that we talked about earlier in the session, what do you look at specifically?
Yep.
And as you find a couple of these patterns, shapes, structures, you need to have a method of how you're going to use that information. And it's not one piece of information that overrides everything. This is not an easy button. There is work that is required. And the work, I tell many students, I want 100 picture perfect trades that have already happened. And my thought behind that is, if you can find 100 picture perfect setups that have already happened, aren't you rewiring what's going on up in the head?
Yep.
You're focusing on what you want to create. You're focusing on what you want to manifest. Therefore, you're getting, stop studying your losing trades. Okay. I mean, people that keep looking at all their losers more than they look at their winning trades to figure out how they can make another winning trade. There's a lot of the psychology that goes along with this inside of that training your eyes. And it's more or less self-psychology. How do I train myself to become an efficient trader and make a profit in the market each and every day? And some of those affirmations do come out as part of verifying the structure. The shapes, the patterns, measurements with Fibonacci extensions or retracements, so you can get the geometry around it, both in price and in time. You start to see these patterns, and you start to help yourself visualize the right side of the chart. Now, the right side of the chart can go up and it can go down. I'm not predicting that. But if it was to go up, where's the most likely place it will go? If it was to go down, where's the most likely place it will go?
Right.
Much of the information that in sharing and training the eyes is not designed to give you a trade. It's to help you understand what you see on a price chart and how you will use that information to make a high quality trade and profit from it. So I'm pretty excited about it. As I was putting the material together, I literally retrained the way I saw things.
Mm-hmm.
And I got even more things were revealed to me, the more stringent and detailed I got onto my my trade plan. I started looking further to the left to and that's where we saw the resistance and support areas, or old supply and old demand being used up. I got a whole different picture of what a used demand or used supply area looked like. And I started to understand, well, you have to have that breakout before you can have the retest of a demand zone.
Yeah.
And the further left I go, I start realizing that if I have a drop-based drop and then 3 touches of that supply zone, okay, that is low on the curve, versus if I have a rally-based drop and then 3 touches of supply or resistance, okay, that's higher on the curve. So I was able to shortcut some of the curve analysis, which helps me assess my risk on a trade by seeing those places a little bit, looking further to the left.
Sure. Just for the viewers out there, that was some of you are going, "What the hell did Jeff just say?"
Where'd he go?
No, a lot of that is the nomenclature of Online Trading Academy. So, Jeff, many of you here are Online Trading Academy graduates, so you understood exactly what Jeff was talking about. But I know there's some newbies out there who are going, "I have no clue what you just mentioned." One of the prerequisites for his signature series class is core strategy. So it's important that you understand that basic nomenclature and kind of how levels are drawn and structured, which is what the class is all about. All right, I'm going to put you on the spot here, Jeff. You mentioned on the August 6th show, you said there's a possibility for, in the next 18 to 24 months, for the markets to double. That's in the S&P, and I'll bring the chart up here just because I would love to look back in hindsight and be like, he nailed it. We are up 10% in the last 138 days. That was on August 6th is when Jeff was on the show talking about that when we were at 33.25. 18 months puts us out at April 2022 with a target of 67.50. Is it still a lofty goal for you, or do you think that that's still doable?
It's still doable. With the melt-up phase, there's going to be a whole transformation of our markets. And many people, I know you have and several others, but we were pretty young in the market when we experienced that first Y2K, the internet bubble and boom. And you remember the amount of money we could make in just a few minutes, just because everything was trading in fractions even.
Yeah.
It's a lot more difficult trading in penny increments than it was in 25 cents, 50 cents, and so on, quarters. This market has the potential of doing that, but keep in mind, there were 5 corrections during the last melt-up phase. And those corrective moves were between 9 and 13%. So if all things being equal, anytime that we have that 9 to 13% correction, you're going to have all the bears coming out of the woods.
Yep.
And everybody's going to keep thinking, oh, the market's crashing, okay? Look, it's just a place on the price chart. If it lines up with your way of trading, you have an opportunity. If we are in a continued uptrend, we will see those pullbacks, okay? And there were 5 of them, and we've only had 1 of them since I started talking about that. And one of them was that correction we saw in March, which was the COVID stuff, okay? And that was a huge correction. But in the grand scheme of things, it wasn't that big, okay? The last time that we did this, the Dow was somewhere around 5,900 back in 1998 or something. Don't quote me on that. I have some slides somewhere. But we saw that go all the way up. It doubled in size. And there was no way anybody would have believed. Even remember old Harry Dent? Is he still out there?
He's out there still making crazy calls.
Well, they're not so crazy anymore, are they?
Yep.
We just hit Dow 20,000, now Dow 30,000, and if by the end of this we might be looking at Dow 50 or 60,000, and then we go into another corrective phase. The corrective phases are generally where people have a stronger desire to get educated.
Yeah.
During this melt-up phase, you're going to see that young kids are making money hand over fist, and you're going nuts because you're still trying to trade the conventional way. Stick around with people that are focused on showing you where to buy and sell. Get your trading strategy down pat so you know what to do with your trading account based on your risk parameters and such. Mm-hmm. But yeah, I'm still looking for that. I'm either going to have a lot of mud on my face or egg on my face, whatever you want to say, in the next, we got about, 12 more?
Yeah.
About a little more than 12, 14 months.
Well, at least you got the huevos rancheros to put it out there. A lot of people are like, well, I don't know, I'm going to just say what I think. Hey, you know what? And the bottom line is this, and this is why I like it. You're basically saying, this is my thought. Here's what I think might happen. I'm going to formulate a plan or a strategy around that, and I will keep pushing that thought and that plan until I am proven wrong. At this point, you have not been proven wrong, right? You've actually been proven right as this market continues up. So as Big Eb puts in the chat, BTFD, buy the friggin' dip. I'll keep it PG-13. I could have used the other F word, but we'll just keep it at friggin' dip, which is I mean, that's it. You can't fight the Fed. You can't fight the government right now. Just keep on going, and hopefully we'll see some more upside. And I look forward to 18 months from now having you back on the program and going, I remember this. You're at 7,000 now. Good job. All right, Jeff.
All right.
Hey, thank you so much. I look forward to your signature series. It starts in March, correct?
The first class is in March, but if you're interested, talk to your centers, talk to your education counselors, and find out. There are some specials that go on towards the end of the year, and you got about 8 more days to get involved with that. You will potentially take the class twice. The first time, it's just going to wow you and overwhelm you with, oh my gosh, I got to get it's exciting. Okay. Then the second time you go home or during the first time you go home and practice it, and you said, oh, I forgot half of what I learned, so let me retake it. There's a buy one, get one free special. Nab that up so you don't have to pay for the class twice.
There you go. Awesome. Well, hey, man, thank you so much. If I don't talk to you before, have a fantastic holiday season, whatever religion you choose to practice. If not, just stuff yourself with a bunch of food, open some presents, and be happy, and I'll probably talk to you in the new year.
I'm going to hang out with my robot for a little while. So.
To the moon, buddy. All right, man. Thank you so much, Jeff.
Thank you. Bye-bye.
Okay, bye. Guys, that was Jeff Manson talking about training the eye, and I wanted to talk about the lift off, the melt up that he's been calling, which he's rightfully so. Seems like 6,600 on the S&P is a long way away, but you know what? The way these markets are moving, anything is possible. And as Big Eb and others have been saying, buy the dips, man. Until we're proven wrong, buy the dips. Just keep on. There really isn't anything right now that's going to be so obvious against us in this marketplace. So rally, keep long and strong. Now, Jeff mentioned he's been teaching this for Online Trading Academy. That's a signature series. I have the page up here. Most of you are Online Trading Academy graduates, so you know this already. But if you are new, you can find out more by going to tradingacademy.com. If you are new and you go there and you sign up for anything, just tell them you heard it at TraderMerlin show. I'm just curious if they ever even acknowledge that I exist or am I promoting Online Trading Academy. Anyway, there is a buy one, get one free right now for these signature series. There are several of them. There's one with Bob Dunn. There's one with Sean Reed, who I'm hopefully going to get on the program here because Sean is just amazing. You have David Warner's doing a signature series. You have Bashir Chaya doing a signature series. And and Bill Addis doing a signature series. So there's like 6 of these things to choose from. So hopefully, if you feel like a holiday gift for yourself, you can enjoy a buy one, get one free. Anyway, let's see what we have cooking for today and tomorrow. This is the calendar for today. Now, we talked about existing home sales as kind of being important. Obviously, we want this market to keep selling more homes and drive prices up because that means people can borrow more, and that means they can spend more, and that means we have what? A continued bull market. Notice the numbers here. The previous month was 6.86 million. They expected it to jump by 140,000 units to 6.7 million. I'm wrong. My numbers are wrong. I can't even do the numbers today. They expected to drop from 6.86 to 6.7, a decline of 160,000 homes on the existing home sales. We actually came out just slightly worse. So not only did the forecast drop, but the actual number came out slightly negative as well. So to me, that's not a great sign, although it wasn't a monstrous miss. You also have consumer confidence dropping. The positive note here would be what you see just above that red box, which is at 7 a.m. this morning. Consumer confidence numbers came out, Richmond Manufacturing Index came out just higher than expectations. It was expected to drop. It actually came out higher, but still only 19. Again, anything above 0 means expansion in manufacturing in the Richmond area. GDP, no big shock there that we came out at 33.4% GDP growth this time, not contraction. Of course, the big seesaw, big rip down, and now we get a big rip back up. Now for tomorrow, we are going to see quite a few announcements for the U.S. Get them all done before we get our shortened Thursday and our closed markets on Friday. Notice the red box highlights it. We've got durable goods orders, you've got personal income and spending, unemployment claims, new home sales, crude oil inventories, natural gas storage. I mean, it's a lot of information happening for tomorrow. Notice that most of that is coming out before the market opens. The stuff that happens while the markets are open are from that 7 a.m. slot, meaning new home sales and down. That is pretty much new home sales, University of Michigan, and some of the crude oil inventories, natural gas storage. That's when the market's already open. Everything else is before that. All right. What did I have? I had something else I wanted to get to, but for some reason I can't. Tomorrow I'm going to go into a lot of listener questions. Many of you have sent stuff in that I just didn't get to, so I will spend tomorrow going over listener questions. I'll probably start off breaking down a little bit this spending bill because I legitimately was awake last night, angry and frustrated at the math. And, I asked you guys to do me a favor and bring up a calculator and type in 328 million people. And that's every living person in the United States of America. That's all of them, right? 328 million people. Out of that 328, my guess is that probably 100 million people aren't going to qualify, maybe less than that, but let's call it 50 million, are not going to qualify for money. They're either too young or they're making too much. Now, if you times that by 600, I don't know if anybody did that, it comes out to be $196 billion. I'm going to round up for the sake of prosperity to $200 billion. Well, the stimulus is for $908 billion. That means $708 billion are not going to the people. That to me is concerning. A lot of the stuff's going international, going to other kinds of crazy projects. So I'll break some of that down tomorrow. I really hope that it gets vetoed or doesn't pass. But of course, this is the easy way for all of our sneaky, slimy politicians to work money into their pockets or their supporters, their lobbyist pockets, because it's an emergency. We need this money immediately. Let's make America fearful, panic, and then we'll slide all this stuff in. So we will talk about that on tomorrow's show. But I'm not going to spend the whole show doing that. I want to get to a lot of crypto stuff. I want to get to some other market pieces because it may be our final show for the year. Yes, a lot of it going to Asia and Africa. I mean, hold on, stimulus? I paid taxes here in the States. I want that money to stay here. And I guess we're trying to help out the world. We're being an ambassador. I'm sorry. Right now, that money needs to stay in the U.S. Keep it here, and it should go to all the people that paid taxes. If you're a freeloader and haven't paid anything, you ain't getting squat. Sorry, I'm a little bit bitter. Anyway, that will do it for today's show, everybody. Y'all should be happy because this is the second 1 hour plus show this week. Big Ab, you're getting to me, man. You're making me do this. Pretty soon it'll be a 2 hour show. I'm not going to do a 2 hour show. But anyway, hope you guys enjoyed today's show with Jeff Manson. If you'd like to partake in his signature series, which is called Training the Eyes, you can register for that at Online Trading Academy. If you don't know the address, I'll bring up that page for you. It's very simple. Just go to tradingacademy.com to find out more information about all of their classes. There are prerequisites for all the signature series classes with Sean Reed, Bill Addis, David Warner, Bob Dunn, and Bashir Chaya, as well as Jeff Manson. So anyway, all right, that's going to do it for me, everybody. I think I got all the information I needed to out. I hope you have a fantastic remainder of your day. Be careful out there tomorrow. This is historically the lightest trading day or trading week of the year. So it gets very, very thin. Next week it picks up a little bit with regards to volume, but this week it's going to be pretty thin, so you'll see some nice moves. By the way, we talked on Friday about Tesla. I hope anybody got a hold of some of that Tesla over the past couple days, but let me bring up that chart here. It's looking pretty nice and tasty to the south side. We talked about the meltdown on Tesla on Friday's show. When Tesla was trading at $695, it's at $640 today, and it traded as low intraday as $614. Anyway, can you do patterns someday? Yes, Raj. I've been looking at doing a pattern show. It's just taking the time to draw everything out. I've got so many other things going on. I know people have been asking me to do work here and comment there and do these. I will do my best, but keep asking, Raj. Don't feel bad about keep asking me to do a pattern show. I want to do one. It's going to be good for everybody. All right, that's going to do it for me, everybody. Have a fantastic remainder of your day. Be safe out there. I will see you on tomorrow's show. Take care.